Understanding the possibility of a reverse market crash. In the world of finance, there is always the potential for unexpected market movements that can either make or break fortunes. One such phenomenon is a reverse market crash, where prices suddenly skyrocket, creating opportunities for some to accumulate substantial wealth while leaving others behind. This video delves into the concept of a reverse market crash, explores its historical occurrences, discusses the reasons behind it, and provides insights on how individuals can navigate such situations to their advantage. The shrinking middle class. Before delving into the concept of a reverse market crash, it is essential to understand the broader economic context. The middle class has been shrinking at an alarming rate, with middle-class wealth declining by nearly 50% while upper-income wealth increased by almost 30%. Additionally, the median household wealth has not recovered since the 2008 financial crisis, and the total population of the middle class in the U.S. has dropped from 61% in 1971 to 50% in 2021. These statistics highlight the growing wealth inequality in society. The role of wealthy individuals. The widening wealth gap can be attributed to the fact that wealthy individuals have more money to save and invest. When interest rates decrease or prices rise significantly, the investments made by the wealthy become more valuable, leading to increased wealth accumulation for the top 1%. This phenomenon contributes to the vicious cycle of the rich getting richer and the poor getting poorer. Historical examples of reverse market crashes. Several historical examples demonstrate the occurrence of reverse market crashes. For instance, after Germany lost World War I, they printed an excessive amount of money, leading to hyperinflation. Similarly, Zimbabwe, Argentina, Turkey, Iran, and Venezuela experienced high inflation rates and soaring stock prices. However, when these stock values were converted to US dollars, they actually resulted in significant losses in purchasing power. Could a reverse market crash happen in the United States? While the United States faces its own economic challenges, such as a massive national debt and political divisions, it is important to note that the country's economy has remained relatively stable over the past 50 years. The US dollar is a globally recognized currency, and the country has not experienced extreme hyperinflation or stock market booms like those seen in other nations. While it is impossible to predict the future with certainty, the likelihood of a reverse market crash on the scale seen in other countries is relatively low. Navigating a reverse market crash. To position oneself favorably in the event of a reverse market crash, it is crucial to adhere to basic financial principles. Saving more than spending, investing in a diversified portfolio for the long term, and avoiding panic selling are essential strategies. Additionally, focusing on factors within one's control, such as reducing overhead expenses, improving job skills, and employability, can help mitigate the impact of market fluctuations. Conclusion. While the concept of a reverse market crash may seem daunting, it is important to approach it with a balanced perspective. The shrinking middle class and wealth inequality are significant concerns, but historical examples show that extreme hyperinflation and stock market booms often lead to adverse consequences. By adhering to sound financial practices and focusing on factors within their control, individuals can navigate market fluctuations and position themselves for long-term financial success.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.